Hey everyone, welcome back to Delta Edge, your ultimate destination for all things stock market. Today, we're diving into top stock market tips for new investors. The stock market can seem like a jungle, especially for newcomers, but it doesn't have to be that way. With the right knowledge and strategies, anyone can navigate the stock market effectively and work towards building long-term wealth. Investing in the stock market without a plan is like setting sail without a map. Before you even think about buying your first stock, you need to have a clear investment plan in place. What are you hoping to achieve through investing? Are you saving for retirement, a down payment on a house, or your child's education? Once you know your goals, you need to determine your time horizon. How long do you plan to stay invested? If you're investing for retirement, you have a much longer time horizon than someone saving for a down payment on a house next year. This is crucial because your time horizon will heavily influence your investment strategy. Next comes risk tolerance. How much risk are you comfortable taking with your investments? Are you someone who's comfortable with potential short-term fluctuations in your portfolio, or do you prefer a more conservative approach? For instance, if you have a long time horizon and a higher risk tolerance, you might consider allocating a larger portion of your portfolio to growth stocks. On the other hand, if you have a shorter time horizon and a lower risk tolerance, you might focus on more conservative investments like bonds or fixed deposits. You've probably heard the saying, don't put all your eggs in one basket. Diversification is one of the most fundamental principles of investing, and for a good reason. Imagine you invest all your money in a single stock. What happens if that company faces unexpected challenges and its stock price plummets? You could potentially lose a significant portion of your investment. That's where diversification comes in. Diversification is about spreading your investments across different asset classes, sectors, and geographies. By doing so, you reduce the impact of any single investment performing poorly on your overall portfolio. Instead of putting all your money into just one company, you could diversify by investing in a mix of stocks across different sectors. This way, your portfolio isn't overly reliant on the performance of any single company or sector. If one sector underperforms, the others can potentially cushion the blow. Remember, diversification is your best defense against unexpected market downturns. Now that we've covered the foundational aspects of investing, let's move on to some tools and techniques that can help you make more informed trading decisions. One such powerful tool is technical analysis. In simple terms, technical analysis involves studying past price movements and trading volume to identify patterns and trends that can help predict future price action. It's like looking for clues in the market's historical data to anticipate where it might be headed next. One of the key assumptions of technical analysis is that history tends to repeat itself. While this may not always be the case, market psychology often plays a significant role in price movements. Technical analysis aims to identify those recurring patterns and sentiment indicators. There are various tools and indicators used in technical analysis, and one of the most popular ones is the moving average. A moving average smooths out price data over a specified period, making it easier to identify trends. Another widely used indicator is the Relative Strength Index, or RSI, which measures the momentum of price changes. The RSI oscillates between 0 and 100, with readings above 70 typically indicating overbought conditions and readings below 30 suggesting oversold conditions. Let's look at an example using Tata Motors. Notice how the 50-day moving average crossing above the 200-day moving average, known as a golden cross, signals a potential upward trend. Remember, technical analysis is just one piece of the puzzle. While technical analysis focuses on price movements and chart patterns, fundamental analysis delves into the intrinsic value of a company. It's like looking under the hood of a car before buying it to assess its true worth. Fundamental analysis involves evaluating a company's financial health, management team, competitive landscape, and industry outlook. The goal is to determine if a company's stock is overvalued, undervalued, or fairly priced based on its underlying fundamentals. There are numerous financial ratios and metrics used in fundamental analysis, but some of the most important ones include 1. Earnings per share, EPS. EPS measures a company's profitability by dividing its net income by the number of outstanding shares. A higher EPS generally indicates higher profitability. 2. Price to earnings, PE ratio. The PE ratio compares a company's stock price to its earnings per share. It helps investors determine if a stock is overvalued or undervalued relative to its earnings. 3. Revenue growth. Revenue growth indicates a company's ability to increase its sales over time. Strong revenue growth is often a positive sign for investors. Let's analyze ICICI Bank as an example. ICICI Bank has a strong EPS of Rs23 and a reasonable PE ratio of 20, indicating it's fairly valued. Fundamental analysis helps you understand the business you're investing in. The stock market is like a living, breathing organism, constantly evolving, reacting to news, and influenced by global events. To navigate this dynamic landscape, stay informed on market trends, economic indicators, and company-specific news. Imagine you're a captain navigating a ship through unpredictable waters. You wouldn't set sail without checking the weather forecast, right? Similarly, in the stock market, staying informed is crucial for making decisions. Fortunately, information is readily available at our fingertips. Leverage resources like financial news websites, stock market apps, and company reports. Websites like Bloomberg and Reuters provide real-time news and expert opinions. Apps like Money Control offer live data, portfolio tracking, and personalized news feeds. Company reports provide insights into performance. Trading platforms like Zerodha have built-in news feeds and research tools. Stay ahead of the curve and make timely decisions. Picture this. The stock market is in a free fall. Headlines scream about crashes and corrections, and your portfolio is flashing red. If your answer involves panic selling, then you're falling prey to one of the biggest enemies of successful investing: emotions. Emotions, particularly fear and greed, can cloud our judgment and lead us to make irrational investment decisions. So, how do you avoid emotional investing? Stick to your plan. A well-defined investment plan acts as your roadmap, guiding your decisions. Focus on the long term. The stock market is volatile in the short term, but trends upwards over the long term. Educate yourself. The more you understand about the markets, the less likely you are to make emotional decisions. Take a deep breath, review your investment plan, and remind yourself of your long-term goals. Now, let's take a look at some real-time market data to understand how the concepts we've discussed translate into practical insights. Remember, the stock market is constantly in flux, so staying updated on current trends and opportunities is key. Looking at today's market, we can see a mix of bullish and bearish signals. Infosys, for instance, is showing a bullish trend with a breakout above its resistance level. This suggests that buyers are gaining momentum and the stock might continue to move higher. Meanwhile, Tata Steel is facing resistance at a crucial level and might see a pullback. The RSI indicator is also showing signs of overbought conditions, indicating that a short-term correction could be on the horizon. It's crucial to conduct your own research, consider multiple factors, and never rely solely on any single indicator. By combining technical analysis, fundamental analysis, and staying informed about market trends, you can gain a deeper understanding of the forces driving stock prices and make more informed decisions.